The Silver Futures Warehouse report just printed deliverable inventory sitting around 100 million ounces on Friday. And the official vibe is basically relax, everything's fine. And I wasn't going to make this video, I'm literally cleaning up my kitchen as we speak. And I'm standing there looking at a mug I should have washed yesterday thinking, wait, are we really about to do this again in the silver market? Because it's not the headline you're going to get if you just skim the usual noise. And I think you deserve the full story. So, here it is. It's Sunday, February 8th, New York time. Comment what day and date you're watching from. Quick thing before we dive in. I'm running a campaign to, the date the market is watching, eliminate copycat channels. If you value this kind of breakdown, subscribe and comment our John AG so the platform knows who you're backing. Now, if you own silver, if you trade silver, if you hold anything tied to silver, coins, bars, miners, funds, futures, whatever, then the next few weeks could get spicy in a way most people won't see coming. And it's not because silver is mysteriously emotional, it's because the plumbing underneath the price is getting tight. And no, I'm not saying the world ends. I'm not saying the exchange is evil. I'm not even saying anything has to snap. I'm saying the setup is unusual, and the calendar is not your friend. Here's what I'm going to do for you, and I'll keep it tight because I don't want this turning into a bedtime story. 3 things. First, what those deliverable numbers actually mean and what they don't mean. Second, why one date, February 27th, matters more than the breathless hot takes. And third, the realistic paths from here, the boring one, the chaotic one, and the one nobody's talking about. And yes, I'm checking. We're recording. We are. Great. Let's go. Okay. Start with the thing people argue about all day on the internet. Inventory. You'll hear someone say, there's plenty of silver sitting in warehouses. And that might be true in a superficial way, but it can also be completely irrelevant because the silver future system has categories. And if you don't understand the categories, you're basically reading a restaurant menu and assuming the food is already on your table. In the exchange's own language, what first notice day actually changes, metal can be eligible or registered. Eligible means it meets the specs and it's sitting in an approved depository. It's real metal, real bars, real weight, real serial numbers, but it's not automatically on offer. It's more like it's in a secured storage unit, and you can see the unit exists, but you don't have the key. Registered is different. Registered is eligible metal that has a warehouse warrant issued against it. Basically, the system's title document that makes it deliverable through the futures process. That's the pool you can actually tap when somebody stands for delivery. So when people wave a giant total inventory number in your face, you need to ask a simple question. How much of that is actually registered? How much is actually ready to move through the delivery window without begging the owner? And as of those latest warehouse updates, the registered pile is roughly in that a bit over 100 million ounces neighborhood. That's not a prophecy, that's a snapshot. It can change tomorrow, but this is the snapshot we have. Now here's the part where a lot of people instantly go off the rails. They look at open interest, how many contracts are open, and they do this dramatic math, like every contract equals someone showing up with a forklift. That's not how futures usually work. Most futures positions are closed or rolled. A ton of it is hedging. A ton of it is spread trading. A ton of it is just people betting on direction and never ever wanting a single bar of anything. So let me be the adult in the room for 10 seconds. Open interest is not the same as delivery demand. If you take that shortcut, you will scare yourself into terrible decisions. But, and this is a big but, delivery demand doesn't have to be everyone to matter. It only has to be enough at the wrong moment when inventories are already lean and borrowing costs are already rising. And that brings us to the calendar. February 27th is first notice day for the March silver contract. First notice day is basically the moment the game changes, from we're trading paper exposure to, okay, if you're still holding the long side, you can now get assigned delivery. It's when the delivery mechanism becomes real, not theoretical. That doesn't mean everyone takes delivery. It means the system has the only inventory number that truly matters to be ready for whoever does. Think of it like this. Most of the year, you're talking about a hotel, nice lobby, pretty website, lots of reservations. But on first notice day, the guests who actually show up at the front desk matter a lot more than the reservations that get canceled. And March is not a random month. March is one of the big delivery months in this market. So that's why this date sits on my radar like a flashing red light. Now, based on recently published numbers, The March positioning is large enough that if even a modest slice stands for metal, it can eat a meaningful chunk of registered inventory. Not all of it, not automatically, but enough to create panic. And panic creates bad pricing. So the question isn't, will the exchange run out tomorrow? The question is, what happens if we go into that delivery window with registered inventory sliding lower while demand for physical access is rising? And yes, I said sliding lower because the other weird thing happening is the flow. Over the past stretch, the vault data has shown steady metal moving out. Not every day is the same, but the direction has been clear. Outflows are not hypothetical. People are withdrawing. And at the recent pace, you're talking about something like 3/4 of a million ounces a day, leaving the system on average, give or take. Now, I know what you're thinking, John. That sounds huge. It is huge. But here's the skeptical counterpoint, because I'm not here to hypnotize you. Warehouses aren't a bathtub with one drain. They're more like an airport. Planes land, planes take off. You can have a week where departures are heavy and arrivals are light, and it looks like the airport is emptying. Then you can have a week where arrivals surge and the entire narrative flips. So the outflows matter, but the real question is what draws metal back in. And that usually comes down to incentives, spreads, premiums, rates, and trust. Which brings me to the borrowing market. One of the quiet signals of tightness isn't the headline price at all. It's the cost to borrow physical metal for a short period. If you want to deliver metal you don't currently have, or you want a smooth settlement, you borrow. And the rate you pay is basically a stress meter. And lately we've seen reports of lease rates jumping sharply into the kind of high single digits territory that turns heads. In normal, boring conditions, those rates are sleepy. They don't scream, they whisper. When they jump, it's not proof of apocalypse. It's proof that people are competing for the same pool of readily available metal. And just to be clear, lease rates can move for reasons that have nothing to do with running out. Rates can reflect financing costs. They can reflect positioning. Paper versus physical, why spreads can open up. They can reflect a temporary scramble around settlement. So again, adult in the room. One indicator alone is not a verdict. But when you stack indicators, calendar pressure, low registered inventory, ongoing withdrawals, and higher borrow costs, you get a picture. And the picture is not calm. Now, zoom out because I promised you fresh context, not just a warehouse soap opera. Silver isn't just a shiny thing people collect. Silver is a working metal. It's in electronics, it's in electrical contacts, it's in industrial processes, and yes, it's in solar. And solar is not a small hobby anymore. According to recent U.S. industry updates, the country installed double-digit gigawatts of new solar capacity in a single quarter late last year, and the pipeline is still heavy. And according to a national lab's recent industry deck, U.S. solar installations for the prior year were around 50 gigawatts direct current. That's not a typo. That's an entire new layer of demand for components and wiring and everything that touches the grid. Globally, it's even wilder. One of the international solar tracking programs estimates that the world added something like the high 500s of gigawatts of solar in a single year. That's a lot of panels, that's a lot of connections, that's a lot of metal moving from in the ground to on rooftops. Now, does every panel use the same amount of silver? No. The industry constantly tries to thrift and reduce usage, but the point is simple. The unit intensity can fall and total demand can still rise because the volume is exploding. And that's before you even talk about electrification. EVs, charging infrastructure, grid upgrades, data centers, these all push demand for conductive materials. Silver isn't the only metal in that story, but it's one of the most effective conductors we have. And if you want a clean, boring, government-style snapshot of how silver gets used, the U.S. Minerals data breaks it down. A big chunk goes to investment bars and coins, a big chunk goes to electronics, and a meaningful slice goes directly into photovoltaics. That mix matters, because it means silver lives in two worlds at once, the monetary psychology world and the industrial consumption world. That's why it can be calm for months and then go absolutely feral in a week. Now let's talk supply, because this is the part where the just mine more crowd shows up. A lot of silver is not mined because somebody wanted silver. It's mined because somebody wanted other metals, and silver came along for the ride. The U.S. Minerals, what rising lease rates can be signaling data spells this out. Silver is primarily obtained as a byproduct from lead, zinc, copper, and gold operations, and those polymetallic deposits account for a large share of resources. Translation: if silver prices spike, it doesn't automatically mean the world can instantly produce a flood of new silver. You can't turn a copper mine into a silver mine by yelling at it. Mines respond on their own timelines and their own economics. So when demand rises and supply can't respond quickly, something else has to adjust. Usually it's price. Sometimes it's substitution. Sometimes it's stockpiles moving. Sometimes it's the paper market doing acrobatics to smooth things until the real metal catches up. And this is where we circle back to the futures exchange and why February 27th is not just a calendar trivia question, because the futures market is a coordination mechanism. It's supposed to help producers and users and traders meet in the middle. But it also runs on confidence. Confidence that when someone wants to take delivery, the system can handle it, and confidence that the price you see is anchored to a real ability to source metal. When that confidence wobbles, the market can do two totally opposite things. It can spike because people rush to secure metal, or it can crash because the exchange changes the rules, margin gets tightened, and speculative players get forced out. And before anyone gets emotional, yes, exchanges can change margins. They do it all the time. In fact, just recently there were public updates about margin methodologies and silver margin levels changing, including moves that raise the cash required to hold positions. That's not sinister by itself. That's risk management. But risk management has side effects, and the side effects tend to hit the most leveraged people first. So here are the three paths I mentioned, and I want you to listen carefully because the right move for you depends on which path you think is most likely and how much pain you can tolerate. Path 1, the boring one. We get into first notice day. Delivery demand is normal. The system sources what it needs. Eligible metal quietly becomes registered, and the whole thing becomes a non-event. Silver chops around. People on the internet claim victory, and everyone moves on to arguing about something else. Path 2, the chaotic one. Delivery demand is higher than usual. Not everyone, but higher. Registered inventory looks thin. Lease rates stay elevated. Spreads. What could happen next? 3 realistic scenarios widen. The market starts to sense stress, and then volatility feeds on itself. In that world, you can see a scramble where paper prices whip around while physical premiums in certain places stay firm. You don't need the whole planet to run out for that to happen. You just need bottlenecks, refining, logistics, vaulting, timing. And path 3, the one nobody wants to talk about out loud, a credibility event. That's where the market starts to treat paper and immediate physical silver as cousins, not twins, where the futures price becomes more like a reference number and the real-world transaction price depends on where you are, how fast you need it, and who you're dealing with. We already see hints of that in other metals sometimes, and we've seen it in gold in past episodes where certain delivery points trade differently than others. It's not fantasy. It's what happens when location and timing matter more than the spreadsheet price. And this is where the geography piece sneaks in and ruins everybody's clean spreadsheet, because silver doesn't live in one place. It lives in vaults, in refineries, in trucks, in customs paperwork, in shipping schedules, in somebody's "will get it to you next quarter" email. So even if the global price is one number, the real price you pay can be one number plus friction. And lately, that friction has been showing up in a way you can actually see. There have been stretches where Asian pricing has stayed firm versus Western futures, then snapped back, then widened again. Like the market can't decide whether it's tight or it's merely nervous. Some commentary has even pointed out periods where the premium looked unusually large and the gap didn't instantly vanish because moving metal across borders is not the same as moving a stock from one account to another. You've got bar formats, approvals, financing, time, and sometimes rules that make easy arbitrage a lot less easy in real life. And this matters because the futures market is designed for people who mostly never want delivery. That's not my opinion. That's how these markets typically function. Most futures positions get closed or rolled rather than ending in physical exchange, which is why first notice day usually passes without drama. So if you suddenly get a higher than normal crowd insisting on real warrants in a short window, it stresses the system, even if the system is fundamentally solvent. And here's the wild card. What if the marginal buyer isn't a speculator this time? What if it's a manufacturer who just wants certainty? If you're building anything electric at scale, uncertainty is poison. You can hedge price with paper. You can't hedge, we can't get the metal on the date we need with a chart. That's why I keep coming back to the same question. Is this simply a trading event or is it a confidence event? Because the trading event burns hot and then cools. The confidence event rewrites how people behave for years. And you don't see it coming from the headline price. You see it coming from the plumbing. Now, I'm going to challenge one implied assumption that's floating around in a lot of silver commentary right now. The assumption is if open interest is huge and registered inventory is smaller, the exchange must default. That's a seductive story. It's also lazy because the system has buffers. Eligible inventory exists. Metal can be mobilized when incentives rise. Arbitrage does happen. And crucially, most people in a skeptical take, why stress might not explode futures, don't want delivery. So a mismatch on paper does not automatically become a default in real life. However, and here's why I'm still paying. Attention. The conditions that make a credibility event more likely are not about one single ratio. They're about behavior, persistent withdrawals, elevated borrowing costs, repeated delivery surges, and rising distrust. And there have been signs of exactly that kind of behavior. For example, from recent market updates, the broader precious metals complex has been in a period of extreme volatility and heavy speculative interest, with silver seeing big swings and a lot of attention from retail and leverage traders. That matters because when a market gets crowded, small disruptions become big moves. And on the physical side, there have also been reports of tightness in major trading hubs, with borrowing costs jumping and spot relationships shifting versus futures at times. Again, not proof of the end, but proof that this is not a sleepy market. So, what do you do with this? First, don't let it turn you into a conspiracy addict. Second, don't let it turn you into a leverage addict. Those are the two fastest ways to get your face ripped off. Let's talk about leverage for a second, because this is where people get hurt. Silver is not a gentle instrument. It can move like a tech stock on caffeine. And if you're over-levered, you don't get to wait it out, you get liquidated. And then you get to watch the market do exactly what you expected without you. So the most useful question is not where is silver going? The most useful question is how much of my money is at risk if silver does something insane in the next 2 weeks. Here's a simple way to think about it without getting fancy. If you have a small slice of your portfolio in silver, say low single digits, then even a violent move in silver is survivable. It's annoying, but survivable. If you have a huge chunk, then a violent move is not annoying. It's identity destroying. And silver has a history of violent moves around moments when the market structure gets stressed. Sometimes it's a squeeze, sometimes it's a flush, sometimes it's a rule tweak, sometimes it's just panic. We've seen episodes in past decades where exchanges tighten the screws during speculative run-ups, and the price came down hard. The point isn't to memorize the past. The point is to respect the mechanism. When leverage is concentrated, rule changes and margin changes can cascade. So, question for you. Are you holding silver exposure in a form that depends on someone else's promise, or are you holding something you control directly? And I'm not judging either answer. I'm asking because the risk profile is different. Paper exposure, funds, futures, unallocated accounts can be liquid and convenient. You can trade it in seconds. You don't need to worry about storage, but it can carry counterparty and settlement risk in extreme scenarios. And even if everything works perfectly, paper can sometimes track the price while your real-world purchase premium behaves differently. Physical coins, bars, how to think about risk and positioning without hype. Allocated storage removes some counterparties, but it adds real-world friction. Storage, insurance, liquidity, spreads. You trade convenience for control. And if you're thinking, okay, John, which one is better? That's the wrong question. The better question is, what problem am I trying to solve? Hedge inflation fear, speculate on price, diversify away from financial assets, secure industrial input. Those are different missions. Now, another question. Do you think February 27th passes quietly, or do you think we get a headline event? Tell me in the comments because I'm genuinely curious how you're reading the tape. And while we're talking comments, here's something that matters more than people admit. If you're successful, share your success story in the comments so others can stay motivated. Now let's walk through what might actually happen around that date. In practical terms, in the futures delivery process, there are specific steps and documents. You don't just shout, "I want silver," and a bar appears. There are notices, assignments, and warehouse receipts, warrants moving between accounts. That's why the registered category matters. That's why warrants matter. And that's why sudden changes in behavior show up in the data before they show up in the headlines. If demand for delivery is higher than the system expects, the system has levers. It can make delivery more expensive by raising margins. It can tighten position limits. It can adjust rules around who can hold what and how. All of that can cool demand. But it can also shake out weaker hands violently. And that brings me to a small but important piece of fresh context a lot of people missed. The exchange has also been evolving contract design, including launching a smaller size silver futures product, which changes how different participants can access the market. Smaller contracts can broaden participation. They can also broaden speculation. So again, structure matters. Now you might be thinking, so is this bullish or bearish? And the honest answer is it depends on the path. The chaotic path can be bullish in the physical world and chaotic in the paper world at the same time. Because if the exchange raises margins, the paper price can drop even as physical premiums remain sticky. That's not magic. That's a credit event versus a commodity event. The boring path can be nothing, and the credibility path can be frankly transformational, but it doesn't have to look like a Hollywood default. It can look like more basis, more spreads, more financing costs, more regional premiums, and a slow shift in how the world thinks about the reference price. Now, I want to add one more layer of fresh information because this matters for why the system is under stress in the first place. We're in an era where governments and industries are paying more attention to critical materials, supply chains. The checklist, what to monitor into the deadline, have been fragile. Refining capacity is not infinite. And industrial demand isn't just nice to have anymore. It's tied to electrification targets, grid resilience, and manufacturing policy. And when you overlay that with the fact that a lot of silver supply is byproduct supply, you get a market that can feel tight for long stretches. Even the U.S. mineral summaries note that global consumption exceeded supply and that this was cited as a reason for price increases. That's not a YouTuber saying it. That's boring government language. So what should you watch between now and first notice day? 1. Watch the registered number trend. Not the one-day print, the trend. 2. Watch whether withdrawals accelerate or slow. Again, trend. 3. Watch borrowing costs and the relationship between spot and futures in major hubs. If you see spot acting strong versus futures and borrowing costs staying elevated, that's the market telling you physical access is valuable. 4. Watch the exchange's risk notices. When margins change, the entire short-term population's behavior changes with it. And 5, watch the rhetoric. Because when the rhetoric shifts from nothing to see to this is normal market functioning, that can be a sign that behind-the-scenes levers are being pulled to keep the machine running. Now let me give you the skeptical counter scenario that nobody wants to hear because it's less exciting. It's possible that the inventory anxiety is being over-interpreted. It's possible that eligible metal becomes registered smoothly. It's possible that the apparent outflows were linked to logistical repositioning, not scarcity.